Today is the 15th of September 2023. Very fast, we are coming towards the fourth quarter of the year already. How time flies. Very, very fast. Right, so let's start off first with the events, and I think one of the most important events that happened recently is the US inflation, and I'd like to update a bit about the US inflation, especially what we're going forward, what we should be looking at, and my thoughts about it. Okay, then after that, I'll also be covering a bit about the ECB's surprise that we also saw yesterday, and that will probably be the wrap up for this week. Okay, so let's start off first with the US inflation update. Now, the CPI year on year, okay, in other words, they call it the headline in CPI, surprised by increasing 0.5% to 3.7. It went to 3.7 from a previous number of 3.2. Okay, so this is a surprising development that we have so far. Other than that, we have the month-to-month. This is to gauge, the sentiment, because if you have the month-to-month going up, that will lead to later on the other areas also as well. So that also came in at 0.6 versus 0.2. So that's an increment of 0.4%, the month-to-month CPI. And I think the most important one would be the core, because if you take away the core CPI month to month, if you take away the what do you call the element of energy as well as food, well, what is the result? Okay, so what we have over here is that, oops, sorry about that. I think there is some, why did it jump? Just give me a second. Just hold on, yeah. Why this one just went cuckoo already? wait, just give me a sec. Okay. Okay, so sorry about that. Let's start again. I don't know what just happened over here. So anyway, it's an update again. I'll restart again. Just now, where were we? We were here. Okay, core CPI month to month, they came in at 0.3% versus a 0.2% previously. So this is another increment in there in this CPI. Okay, so with this, what we have is that we have three numbers coming in, three data coming in showing that inflation is up, right? But there's a big but over here. If you throw in the core CPI year on year, okay, it came in at 4.3 versus 4.7. Now, this is what the Fed is actually looking at. Okay, they want to see if you were to compare last year and this year, how is it doing? So if you were to use this, that means this core CPI year on year would be a counterbalance to whatever the news that came out over here, right? And furthermore, if you were to compare, you would see that core CPI year on year, 4.3% means it has dropped for 5 consecutive months already, comparing year on year. Okay, so what happened next was that we had the US dollar index trading sideways right after the news. Okay, first it came down, it went up, but but it ended the day right in the center. It came down, went up, and right the day entered right in the center. That shows that, it's like, hey, what's really happening over here? What's truly happening? If you look at the euro dollar, same thing. You look at the dollar index, same thing. Everything, it was a muted movement. You put it that way. Okay. So a deeper look into the inflation numbers, however, shows that underlying inflation is still proving to be very sticky. And I believe that the rising oil prices is the main culprit right over here. It's causing a lot of concerns because oil has risen to 90 and is slowly moving up. If there is more momentum towards the oil, then it can severely derail, okay, the progress, where central banks will be looking into seeing, if not hike, but maintaining the high interest rate environment for a prolonged time. Okay, so one of the reasons that the oil price is going up right now is the tight supply outlook, as well as the OPEC's optimism over the resilience of energy demand in major economies. Okay, and because of the OPEC's view and this kind of things, the oil price right now at $90 per barrel is trading near 10-month high already. Now, of course, and not everything is just put on to the blame of oil prices over here. The other part that is playing a role in this inflation is none other than the consumer wages. Now, the increasing consumer wages definitely, it's one of those other things where as long as people's pocket, they have this money, they can continue to support. But of late, we have seen that slowly winning down. So we have to see the moment the wages move into the negative territory, then it will help a bit. Okay, then it will help a bit and you start see things change, but you have to give it some time, probably another quarter or so, then we will see. Okay, especially end of this month, you will see the beginning whereby the students in the US will start to pay their student loans once again. All right, now that would be the US inflation news update right over here. I'll cover more on Monday with regards to the interest rate hikes area, what the probabilities and the outlook and everything. Okay, now next I want to talk about is the European Central Bank surprise. Now, what we saw yesterday is that the European Central Bank hiked its bank rate for the 10th time, bringing it to 4.5. We did not expect that to happen. What was expected was the ECB to maintain its rate at 4.25%. And there was a surprise whereby it hikes rate to 4.5. Now, according to CNBC, a key reason for the hike on Thursday appeared to be upwards revision in newly published macroeconomics projections for the euro area, which sees inflation averaging at 5.6% this year from a prior forecast of 5.4%. Another area that's showing very inflation is still stubborn, and 3.2% next year from a prior forecast of 3%, right? So that's one of the reasons. But one thing is, at least now we have some clear guidance. With this hike, however, the ECB has hinted, okay, that it would be the last for this cycle. Now, it's reflected in this statement, the hint. Based on its current assessment, the Governing Council considers that the key ECB interest rate have reached levels that, maintained for a sufficient long duration, will make a substantial contribution to the timely return of inflation to the target. So this is a way of them telling that, hey, we have reached the top already. Okay, of course they're not going to say we are not going to increase anymore, but from here it's clearly stated already. So unless we have extraordinary developments in inflation and stuff like that, I don't think the ECB is going to change. So at least now we have one central bank stating that, okay, we have stopped, we are not going to hike anymore. Okay, so that's clear already. Now it's how the rest of the other central banks, the Federal Reserve, RBA, RBNZ, the BOE, what are you going to do next? That is the key point. Now, just think of this. Now, if you have the rest of the central banks hinting that they are going to cut the rates, no, sorry, they're going to pause their rate hikes. But if you have the BOJ saying that, yes, probably by the end of this year, if we see wages start to go up in a sustainable way, like what I discussed with you on Wednesday, then you would see the yen pairs, you will see yen strengthening. So then you can change, and if the structure confirms that all the yen crosses, they are going to strengthen already towards the yen, then you can actually trade it that way. Okay, so that's how we work out our systems, in trading over here. And with that, yeah, that's the end of the fundamental report for today.